Good day, everyone. So, we're going to go ahead and briefly go over our irrevocable trust setup and exactly why we use the irrevocable trust rather than actually using, a revocable trust like most people have thought, or just a C Corp or S Corp. Um, we're going to go ahead and touch on exactly what we were discussing briefly a few days ago. So we're going to quickly review that and then we'll jump right in and then I'll leave you with some examples and then you'll be able to ask your questions at the end. Remember, everything that we're doing is to help put you in the best position possible to not only accumulate wealth, but then to be able to distribute that wealth wholly to your family or to, a charity of your choice, but to be able to do so without having most of it being either separated through lawyers and probate or through disputes between, beneficiaries or those who you love. All right, so we're going to go ahead and jump into this really quick. If you guys give me a second, I'll pull this up here. Let me go ahead and jump out of the way. Now, what you guys are seeing here, let's go ahead and do this. What you guys are seeing here is our entire better banking, better borrowing, and better investing program. And you remember everything we're doing here is to help you accomplish your real wealth goal. We figured that out in pillar one, step one, when we went through our DDP process, which is our discovery, diagnosis, and prescription. Once we figured out where you are right now and where you want to be, we then put together our custom blueprint to help you bridge that gap. In pillar two, you were learning our entire process. Like I said, a lot of the stuff that we're doing isn't traditional, but it's exactly what you need to be doing in order for you to accomplish your goals, your financial goals. So we teach you that here in our better banking, borrowing, and investing education. And then we also teach you some of our more advanced investing strategies, right? We have them broken down into tier one, tier two, and tier three. And this is your interest based investing education where you specifically pick one of our investing vehicles and you learn exactly how we do that specifically. So I'm going to use in this particular example real estate, which is tier two of our investing, along with this example of why we set up in pillar three, why we set up our AAP blueprint the way that we do with our family trust down here. So we're going to briefly go into that. And like I said, everything we're doing is to make sure we are not part of that 95% that will not be financially secure at retirement age. We want to make sure that we're in that top 5%. And there's things that you can do that will put you in position to actually accomplish that. So, what we're going to do now is we're going to go ahead and move down to this setup. Whenever you get to, and you will learn about this here in pillar three, step three, when you're in this educate in a real wealth university. But more importantly, when you actually start to implement that, which is here in step three, and we would already got your personal credit together, maybe your business credit together, and now we're working on putting you in the best position as far as not only investing, but then keeping as much as possible of what it is that you make. So when we come here and we're setting this up, if you look at it, most people will start off, let's just say down here. Let's move this up just a little bit. Right here with their current business. And this can be a LLC, it can be a S Corp or C Corp. But most people would just start off with that business and that's it. So whenever this business makes money, it immediately comes out to that person. And that obviously would increase their actual income that they would have to report, right? So there's a lot going on there, and I understand why you want to create the LLC, and we can take a look really quick before we come back at this diagram here. We have our AAP asset and income protection graph, and you can see anything that you have in your own name or general partnership when it comes to your income, you're going to have no protection, 0%. Any assets that you have in your own name or in a general partnership, also no protection. Some people will implement the single member LLC, which is what we were just looking at. And that does offer minimum income protection and also minimum asset protection. But it is more protection than just having it directly in your name. Then we have some that implement the multi-member LLC, S Corp, or C Corp. This is basic income protection, and it's better than the two previous. Also the same on this side. And then what we're speaking on today, the difference between why we use the irrevocable trust rather than the revocable trust. But most people can see that the revocable trust does provide you advanced income protection and also advanced asset protection. So we can see that, but it's at 50% because if you do something while you're alive, this box that you've put everything in, this trust, this revocable trust, they can make you open this box up and go in there and grab the stuff out. So lawyers, judges, creditors, divorces, things like this can make you have to go into that revocable trust. Now, if nothing happens while you're alive, it does offer you protection when you're it does offer you protection whenever you're gone. So it will bypass probate. It will your beneficiaries won't be able to necessarily dispute what's going on because, like I said, you could have laid a lot of stuff out within your trust. But once again, you have to make it that far. So that's not really the protection that I think most people want. What you want is the irrevocable trust. And that's because what you put inside of the irrevocable trust, no one can make you go in there and get it out. Right. So you have your asset and your income protected in a way that allows you to allow it to build up while you're alive and then pass it on intact. So we're going to go ahead and take a look at exactly what that looks like over here. So as we were just showing you, most people current setup is just the business, and then the money goes directly to them, and then they need to report that. So if the business does something, they're protected, right? That's the limited liability, right? So you're protected if the business does something, but if you, the individual, do something like backing out of, McDonald's and someone spills some coffee on them, they sue you, something like that. If a lawsuit of any kind happens, well, now everything that you own, including this business, so all your personal stuff that you own, including your business, all of that stuff is now exposed, right, with this setup. And you don't necessarily know that until something happens. And once again, even if it's in a revocable trust, that is still the same. That is still the same scenario. Now, the way that we set it up is we have you set up we call it a family trust. This is an irrevocable trust. It is a non-grantor irrevocable trust. So you will not be the grantor or the trustee on this trust. Very important. We'll get into that in a second. And you want a non-interest bearing bank account when you set up the bank account for this trust. Irrevocable trust, they don't even have an EIN because there's no need to separate this. This trust is going to have an EIN, and you'll see why. So once this is set up, and there's 10 steps that we do that we'll get into on Sunday to actually help you set this up. But just understand that once this is set up, we then want to come to your holding company. And this holding company is set up in Wyoming. And we pick Wyoming for a very specific reason, not the Nevada or Delaware or anywhere else, because we want something called charging order protection. And charging order protection means that if a scenario happened where we, just like I described down here earlier, where we essentially do something and get sued, stuff inside of a charging order protection is a little bit more protected, meaning they have to produce that charging order to that particular district or that particular state. So that's what we want. We want that extra layer of protection. And then we also want it to be a manager manage, not a member manage, a manager manage. And that's because we're working on that anonymity, that privacy. And when we have a manager manage business, we don't have to put the owners on the Secretary of State filing. We can just put the manager on there, and that gives you some privacy. So we're still working on that privacy, right? Your anonymity, and we're also still working on the asset protection. And this is going to be a LLC taxed as a C corp. And there's very specific reasons on why you would want to do that. You want to wait till you get over about 60,000 where it starts to make sense, but you want to do that because it adds extra layer of protection, but also gives you something like retained earnings where you can hold money inside of the business without actually being taxed to use, for the expansion of the business. But now we're going to move on to the members, right? The members are going to be at least you in whatever percentage you want, 10, 20, 30%. We try to keep it somewhere within that range, but whatever it is that you're looking for. And then your trust will own the rest of this business. And keep in mind, we just said that the owners are not listed in Wyoming. So this is private, but this is how the percentages will be broken down. And um, that is going to work out in your favor here in a second. And then whatever state that you're actually in, so if you're in Florida, Georgia, New York, Texas, Illinois, wherever you're at, you're then going to open up a business, a disregarded LLC, so that all of the profits, everything that this business makes, it goes to the owner, right? So there's no extra paperwork. We want to do that, but now you're actually doing business within your state. This is called your operating business here. This is your holding company or your protective entity. And what we're doing now is we're allowing this business to generate income just like you would when it was just this business down here, the current LLC. But the difference now is the ownership structure. So this business, let's just say it's doing real estate, it will still, buy and flip real estate and have the money coming in. So it'll still have the revenue. And we're going to break this down here in a second too, just so you can see how the actual flow of money works. And then I'm going to give you guys a bonus at the end as well. But what I want you to see here is that as we're looking at the actual uh, the flow of money, when you make this is total revenue. Now, your business is always going to have its expenses. So you're going to take care of your expenses, and then whatever's left of that, right, is going to come up here to this business. And then you are going to take your 10%, right, in your 1065 K1, you're going to take your percent or 20% or 30%, whatever. You're going to take that. And then the remaining balance is going to go up here to your trust or your family trust. And according to, and this is where we're getting, it is not getting complex, but this is where you definitely want to start paying attention. So according to IRS code 643B, all extraordinary dividends, right? Meaning if you're going to take these dividends and you allocate them to the corpus or the principal of the trust, you can defer those taxes in perpetuity. And this is super, super powerful if you understand exactly what that means. That means that that money that comes up here to this trust, if you're allowing it to build up and you're allowing it to grow, and you have a clear understanding on why you're putting that money into that family trust, right? For your legacy, for your family's legacy. And you allow, this can be super powerful, because where you would normally have to pay a big chunk of that into taxes and other things, into, interest payments and so on and so forth, you can cut a lot of that out. And I'll demonstrate that here briefly, just so that you can, see what I'm saying. But I hope you understood the flow of money and how it goes up the chain as you are generating your total revenue down here. What's left then moves up to here. You will then take yours through a 1065, and then the rest would come up here. Now, let's erase this, and we're going to do one more thing here. So now, inside of all businesses, look at the flow of revenue. Inside of all businesses, the flow of revenue breaks down similar to this, right? Let's just say your overall business generated 120,000. Let's just say the cost of goods and services sold was 30,000. So that's about 2,500 a month. So your gross profit is 90,000. You have your operating expenses at 36,000. This is, what you need to do to keep the business running. That's another 3,000 a month. So your operating profit is 54,000. Now, let's just say you got interest payments and so on and so other things that you have to pay, but they're not necessarily for operating the business. These are your non-operating expenses. Let's say that's 7,500, so that's another $625 a month. So your profit before taxes is $46,500. Now, if you had to once again pay taxes, now that money would normally just go right to the business owner in the example we use down here, where the money would then just go to the business owner, and they would have to pay the taxes on that. If the business was set up where, like people will say, it's a double taxation situation, where you have to pay, the corporate tax at 20%, and then you also have to, once you get it, you have to then pay your taxes. We're not trying to set that up. We're just going to try to keep it super simple, that after all of this stuff is paid, number 7, profit before taxes, that 46,500 will then be going on the owner income, therefore increasing the owner's income if they have a regular 9 to 5 and this was a business that they were doing. Or if that was all of it, that would be what they would end up paying as their income. So then we would need to go ahead and, subtract everything from there. But I want to do something for you. Let's say, and I want you to keep this in mind, the flow of business revenue. Now, let's just say once this business here has done all of that stuff, because it's the one that's operating and producing the income, that 46,500 then comes up here to this business here. Because remember, it is the owner of this business. So the money is now going to where it needs to. But now each owner is going to pay their portion, right, of the taxes. So the 46,000, 10%, 4,650, that's going to go to you, because that's your 10%. If you had 20%, that'll be about 9,000. And you can keep doing the math. And then the rest, let's just say in this situation here, about 42,000 is going to go to your family trust. And here's the key thing. This is super, super important. So now that 42,000, whereas before you would have had to pay trust, let's do this. And this is super important. If you guys can see. So we have your 1040. Everybody's probably familiar with that. Here's your partnership, that 1065. But let's come over here to this right here, this 1041. And you can see this broken down into income, deductions, tax and payments, and then you sign here. But let's come back up here. And let's go ahead. Now, we said it was about 42K. Correct? 42K is what the trust would have gotten. Now, is that interest income? No. Right? Is that total ordinary dividends? That's number 2. No, 0. Is this a qualified dividend allocatable to the beneficiary or to the estate or trust? Yes. How much and to who? So in this case, it's 42,000 to the trust. And the reason why it's important, if it went to the beneficiaries, we're going to come back and you'll see how that works out too. But now we got 42,000, and then we're going to go on. If there was capital gains, rents, and royalties, right? We're not doing any. This is the family trust, right? So it's not operating, and that's why we set it up. So all these other things you can look: ordinary gains and losses, other income. But when you get down here to line 9, it says combine lines 1, $0, 2A, $0, and 3 through 8. We got $0, 0, 0, 0, 0, 0. So when we add up our total income, guess what? It is $0. I'm gonna let that just sit there for a while, because this, if you only understood, if you so, and let me come back up here to show why this line right here is so important, and why just reading and researching and being educated, financial literacy, right? Going back up to pillar 2. That's why this is so important. So if you would have put the 42,000 here for the beneficiaries, the trust still wouldn't have any taxes to pay, because that money would have went to the beneficiaries. They would then report that on theirs and they would pay that. Does that make sense? So essentially, you now have 42,000 inside of the trust, and you can once again do this every year in perpetuity. And this is, and then the trust is going to, if we come back over here, let's actually come down. The trust is going to start to take over a lot of things that it should be taken care of. You don't necessarily need the money for those things, right? We call it the 3 F's. You need money for food, fun, and fashion. Everything else, your home and the trust should be taken care of. These big things, you don't need that, because once again, anything in your name that you need to take care of is a liability. That's what we discussed. If you have a house right now and the house is worth 450,000 and you only owe 375,000, well, that's 75,000 in real capital that needs to be protected. Because if you were to do something, you specifically, the person, well, then you will realize that that was real capital, because somebody else will say, well, they got $75,000 in equity. They need to pay this such and such judgment, or this, whatever that might be. These are real things that you need to think about. And a lot of the time, a lot of us don't do this thinking ourselves, because we think other people have done it for us. So they gave us the best that they possibly could. And that's not been my situation, which is why I figured this stuff out and implemented it for myself and do it for myself. Because at the end of the day, I got the revocable trust at the beginning, and had to learn the hard way. So um, these things are doable. These things are beneficial to us and our family. And like I said, we're going to go into this a lot more deeper on Sunday. Let's go ahead and come back up. Yeah, give me 2 seconds. So I want you to understand that all of this stuff is not only doable, but it's almost a necessity at this point, just because of the way things have been going, um, with the economy, with the world, really, because a lot of other countries are up under our economic system. So a lot of the things that this protects you, from, and this helps you with, they're necessities now. So, like I said, we're having a class this Sunday where we're going to start breaking this stuff down. We're going to help you understand why you would want to implement this and how, and then we're going to answer any other questions that you might have. So, what I'm going to do now is we're going to come back up because I want you guys to see if that's better. Right, all of this that we've discussed so far in this short time has been the family trust, the holding company, and the land trust. If you have a piece of property or if you have rental property, that's all we've been talking about, the AAP blueprint. We haven't discussed any of the other stuff in Pillar 3 or discussed Pillar 4, 5, and 6. And that's more of investing, where, as I said, we're going to discuss the real estate investing using this setup in the next video. I just wanted this one to actually break down exactly how we set things up, why we set it up, and why we use an irrevocable trust over a revocable trust. If you guys are already members, as you can see up here, you can go ahead and set your consultation up through the 30-minute, 60, or the 90 right here. If you want to go ahead and become a member and actually start, implementing this, use this QR code so that we can gather your real wealth blueprint. We can gather your questions from that questionnaire, and then we can go ahead and start building out your plan. And then also, if you've already filled out that questionnaire, go ahead and use this code, and we'll already have it. So then we'll just go ahead and get with you about a day and a time so that we can then go over your blueprint and start moving forward. If you want to see what else we offer inside of the IBC Club, you can scan this code down here, and it'll give you our offer document, and it'll go ahead and let you see exactly what it is that we offer, what you're getting for your membership, and also why we're doing what we're doing. So if you need anything, you can let us know either right up under the video, or if you're already a member, you can just reach out to us directly. All right. I hope this was informative. I hope you guys do understand now why we use an irrevocable trust rather than a revocable trust, and what are some of the benefits. All right. I'm going to go ahead and drop this inside the group. You guys let me know if you have any questions. All right. I will talk to you guys here shortly.